Capital gains taxes are one of the most important considerations for any real estate investor. While appreciation builds wealth, it also creates a taxable event when you sell. And here's what surprises many owners. Profit isn't the only thing that's taxed. The depreciation you claimed over the years must also be accounted for. Understanding these fundamentals helps sellers plan ahead, protect equity, and avoid unpleasant surprises at closing. Capital gains are calculated based on your adjusted basis, not just what you originally paid. Your basis starts with the purchase price, adds capital improvements like new roofs or structural upgrades, and subtracts depreciation taken over time. The result is your adjusted basis, the number used to determine your taxable gain. Because depreciation steadily lowers this number, long-term owners often face larger tax bills than expected, even if the property's market value hasn't increased dramatically. How long you held the property also matters. Assets held for 1 year or less are subject to short-term capital gains, taxed at ordinary income rates up to 37%. Properties held longer than 1 year qualify for long-term capital gains rates, typically 0, 15, or 20%. High-income earners may also owe the 3.8% net investment income tax. Depreciation is handled separately through depreciation recapture. Over time, the IRS allowed you to deduct part of the building's value. When you sell, those deductions are recaptured and taxed, capped at 25% for long-term holders. This isn't a penalty, but a reconciliation of tax benefits already received. A 1031 exchange allows investors to defer both capital gains and depreciation recapture by reinvesting into another like-kind investment property. This lets you reinvest your gross equity instead of your after-tax proceeds. The rules are strict. You have 45 days to identify replacement properties and 180 days to close. While a 1031 doesn't eliminate tax, many investors use it repeatedly and may eventually pass properties to heirs who receive a step-up in basis. That said, paying the tax can make sense if you need liquidity, want to simplify your estate, the exchange costs outweigh the savings, or you can offset gains with losses elsewhere. Finally, a few common questions. The $250,000 or $500,000 primary residence exclusion does not apply to investment properties. Repairs are deductible in the year incurred, while capital improvements increase your basis. And you generally cannot exchange directly into a REIT, though some investors use Delaware statutory trusts for passive ownership. Tax planning shouldn't be an afterthought. It should be part of your exit strategy. Platforms like Real Estate Broker Match connect investment property owners with brokers experienced in tax-sensitive transactions to help optimize long-term outcomes. Thanks for taking the time to watch and for giving this topic your attention. If you're interested in learning more or want help navigating a sale, you'll find a link below to Real Estate Broker Match, where property owners can connect with brokers who specialize in their specific asset type. I'll also include a link to our blog below, where we break these topics down in more detail and share practical insights for commercial property owners. Thanks again for watching.